SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BAFFI Bocconi e-lecture on financial stability risks from geoeconomic fragmentation. A new ECB-ESRB report examines the link between geopolitical and geoeconomic risks and financial stability. It introduces a comprehensive framework for regular monitoring of geopolitical risks, integrating a wide array of quantitative indicators with a rich empirical modeling foundation to evaluate the impact on the financial sector. The framework is an instrument for policymakers and financial authorities, enabling a systematic assessment of how geopolitical developments affect macro-financial conditions. The work contributes in three important ways to risk monitoring. First, it establishes a monitoring toolkit for indicator-based analysis of geopolitical risks that can be readily integrated into existing financial stability frameworks. Second, it explores the macro-financial transmission of geopolitical shocks using state-of-the-art econometric models. And third, it draws on granular datasets to document how banks and non-banks adjust to geopolitical shocks and periods of elevated policy uncertainty. When we scheduled this event roughly a month ago, we did not anticipate that it would so quickly become highly relevant. With this in mind, at today's e-lecture, we will aim to first explain key elements of the ECB's new approach. Second, discuss strengths and areas where further development might be worth it. And third, link this framework with the current unfolding of new extreme geopolitical tensions and risks. We are privileged to have with us today the two leading authors of the ECB-ESRB report. Let me give a warm welcome to Stephan Fahr, Principal Financial Stability Expert at the European Central Bank, and to Matei Kubinschi, Deputy Director, Financial Stability Department at the National Bank of Romania. Then, three top experts will discuss the report, point out ways forward, and add additional ideas and analyses. Please welcome Simona Malovaná, Executive Director, Research and Statistics Department of the Czech National Bank, Falko Fecht, Head of Research at the Deutsche Bundesbank, and Álvaro Ortiz, Head of Big Data and AI Economic Analysis at BBVA Research. Without further ado, over to you, Stephan and Matei.
Thank you, Ernest, for the kind words of introductions, and more generally for having us today at the SUERF. This report on financial stability risks from geoeconomic fragmentation integrates insights on how geopolitical risks affect the EU, individual countries, and financial sectors. It was developed by a joint workstream under the ESRB's Advisory Technical Committee and the ECB's Financial Stability Committee, and was led by Matei Kubinschi from the National Bank of Romania and myself, as mentioned by Ernest already. Now, the report consists of 6 sections, and in today's presentations we will selectively cover these. Next to the introduction, section 2 focuses on the framework for assessing geopolitical risks. Section 3 dives into the available data and measures different aspects of geopolitical risk. Section 4 then covers the macro financial transmission with different types of econometric time series tools. And section 5 looks at the financial market impacts with spillovers and predictive markets. It is not represented in today's presentation, though. But section 6 covers analysis based on micro data sets with insights on financial institutions, relevant also in the discussion by Falko. And finally, the annex provides additional methodological information and robustness analyses. So let me move from the report to today's presentation. And here we will be going in 3 parts. I will present measuring geopolitical risks, so the categories and the different indicators. Matei covers the macro financial impact, and I close with more granular analysis on the financial institution. So let's move to the framework at first. Let me initiate with a framework we designed for assessing geopolitical risks and their transmission, as it helps to structure the link between geopolitical risks on the left and financial stability dimensions on the right. The framework categorizes different types of geopolitical risks and identifies transmission channels. We measure geopolitical risk with about 40 individual indicators grouped into 5 categories: military conflicts and wars, infrastructure vulnerabilities, trade disruptions, risks to capital flow and finance, and political and societal factors. These risks often translate to uncertainty and volatility, which then transmits through the financial system, the real economy, and also involve operational risks. In this report, we focus on the financial channel. Heightened uncertainty and volatility tighten financial conditions and increase credit, market, and liquidity risks. These vulnerabilities then can amplify the effects of geopolitical shocks, leading to systemic risks and amplifiers. This framework expands on the analytical structure by the ECB banking supervision so that we are really consistent in terms of on the supervisory as well as on the financial stability side. So this is the framework and provides the structure. Now we will populate it with the indicators that we have. The initial set of 40 indicators spans a broad range of geopolitically related aspects. We decided to start with a wide interpretation, not the least to establish a data set of reference. Some would say that certain dimensions like volatility are broader than geopolitical risk, but we nevertheless considered it because uncertainty and volatility are strongly linked to geopolitical risks and should be analyzed alongside. For a broad coverage on this complex topic, our dataset combines high-frequency financial market signals, official statistics, and longer-term trends. It includes news-based indices like geopolitical risk and trade or economic policy uncertainty, model-based measures such as real, macro, and financial uncertainty by Jurado, Ludwigson, and Hung, and event-based measures like counts of global sanctions, just to name a few. We mapped each of these indicators by category, that's on the left, but also by statistical groupings on the right, involving uncertainty, volatility, and fragmentation trends, in order overall to get a better structure and a better hold at all those indicators that we found. Grouping the indicators has been an important step to develop narratives and to measure geopolitical risk within the different groups in a robust way. Based on a structured selection process guided by topical, statistical, and operational criteria, we distilled the top 15 most important indicators or most informative indicators. This selection may be found in the annex, for example. So based on these 15 indicators, one tool that we developed is obviously a heat map that is to build the geo heat map that is also categorized in these 5 categories that we mentioned before. The representation can seamlessly integrate it into existing monitoring frameworks that central banks use on a regular basis. Our current reading shows that over the last 2 decades, geopolitical risk and uncertainty have broadly risen with a strong intensification since 2020, namely the COVID crisis, and policy uncertainty reaching historical highs in 2024-2025. Other indicators point to greater fragmentation by a declining trade openness and stronger financial fragmentation. While uncertainty surged, financial market volatility, so that's in the capital and finance grouping, the COVOL indicator, measured by the Common Volatility Index, the COVOL, remained moderate, suggesting that so far, vulnerabilities and stress in the euro area did not move in tandem with geopolitical risk. But the dichotomy between the developments of uncertainty and volatility highlight the potential for sudden shocks to ripple through the financial system. Hence, the importance of looking at risks to the financial system overall. Let me go to the latest readings of some of those indicators, those that can be most kind of updated to the closest of our times. And I know that Álvaro will have additional kind of updates on this. For this slide, we selected those indicators which can be easily tracked through to the beginning of 2026, and we can confirm the reduction of geoeconomic risk from the highs in the second quarter of 2025. The second quarter of 2025 is captured by the in yellow line. This is in particular the case for the indicators related to national security policy and trade policy uncertainty. Economic policy uncertainty decreased the least. That's the top, that's at the top. With the conflicts surrounding Greenland, Venezuela, and now also Iran shaping developments in 2026, we see trade uncertainty and geopolitical risk indicators widening again in January this year. We also see that financial market volatility increased lately from low levels. We will need to see if this follows the similar pattern as in the past, namely that volatility rises before it kind of recedes at the same later on. So that was on the left. When we transform these values into percentiles, and that's on the right, we find that indicators remain relatively high from a historical perspective, as seen in the red and gray lines that are very similar to the yellow line. The reason behind this discrepancy lies in the nature of the data, which has high spikes for a short period of time and recedes quickly. This makes lower readings still appear high by historical standards. Overall, the data points to persistently elevated economic policy uncertainty and ongoing geopolitical risk. A positive message among the indicators relates to so far lower global supply chain pressures and low levels of market volatility, though these have also already increased, and this may change obviously with the current geopolitical situation around Iran. Now, this brings us to the macro financial analysis to be presented by Matei.
So thanks a lot, Stephan, for the introduction, and thank you for your invitation. It's a real pleasure and an honor to be here today to present our work. So let me just dive in the interest of time. So now that we've set up the risk monitoring framework, now the natural question is, what do these geopolitical shocks actually do to the economy? And now we will have 4 complementary approaches. So first of all, we look at how GPR shocks actually move through the most important global economies. So we start with a sort of a bird's eye view of things, and we use a multi-country factor augmented VAR model, which includes a large set of macroeconomic and financial variables for the biggest economies in the world, G7 and Euro area economies. So what we find is that geopolitical shocks, of course, travel through 2 main channels, a financial channel and a macroeconomic channel. This is not surprising. The financial channel works through uncertainty and risk aversion mostly. So when geopolitical tensions rise, we see that markets tend to get nervous, as they say. So we see higher volatility in equity markets, wider corporate spreads. But at the same time, the macroeconomic channel kicks in. So confidence weakens, exports slow down, and global demand softens. On the supply side, we can see that these shocks usually can generate inflationary pressures, for example, disruptions in shipping routes. And I can think about one recent example which is very relevant, or supply chain disruptions, which can raise, of course, costs and ultimately translate into consumer prices. Now, here's an interesting part. So when we design a counterfactual experiment and switch off the reaction of financial markets in the model, we see that macroeconomic effects become much weaker. So in other words, financial markets act as an amplifier. So they take the initial geopolitical shock and spread it much more broadly across the economy. So the takeaway here is quite clear. So financial markets play a key role in propagating and sometimes amplifying geopolitical risk shocks. Now, if we move to another perspective, we can see that geopolitical risks are really interesting from a financial stability perspective, because they usually tend to affect directly the tails of the distributions. And to study this, we use two quantile-based approaches. So the panel quantile regressions and the quantile VAR models. These models allow us to look not only at the average outcome, but at the bad outcomes, as they say, or the lower tail of growth, financial stress, and systemic vulnerabilities. So they're particularly useful in our case. So for the EU benchmark growth at risk model, we include 5 measures of geopolitical risks, along with systemic risk indicators and financial market stress. So we use EPU, economic policy uncertainty, to mimic general uncertainty. We use the GPR for military or infrastructure risks, the trade uncertainty indicator for trade, and the COVOL, the common volatility, for capital and finance. And finally, the migration index, which is a proxy for the politics and society section of geopolitical risks. We usually find that tail estimations for economic growth and the macroeconomic variables widen pretty significantly starting from 2015, and so this is how we can evaluate the fact that geopolitical shocks have a growing importance over the last decade. Presently, when we look at the most important drivers, we see important contributions coming from the EPU and trade uncertainty, while contributions during other events such as COVID or the Russian invasion in Ukraine have a more balanced picture between the five categories. Now, if we zoom in on the growth at risk model, which incorporates the EPU, which is generally, let's say, one of the best performing indicators for general risk and uncertainty, we see that it's particularly relevant in explaining EU level dynamics. So we find that it captures significantly elevated downside risks to GDP growth after 2018, and this is shown on the right-hand side chart. So if we look at the decomposition in time, we see that the EPU contributions turn increasingly negative from 2018 onwards, and they persistently bring down the tails of GDP growth by around 1 percentage points since 2022. So basically, they're one of the main sources of downside risk. Therefore, it's quite clear that general economic policy uncertainty is one of the main drivers of downside risks in the EU. Now, if we can go to the next slide, to go one step further, we can use quantile VAR models, which are particularly useful to analyze structural shocks and counterfactual scenarios. So these models, again, allow us to see the entire distribution of macrofinancial variables, not just the average path. So for our case, we choose a similar specification to the growth at risk. So we use GDP growth, systemic risk, financial stress, and then we complement the model with an external geopolitical risk indicator. One interesting result is that the geopolitical shocks affect the lower tail of GDP growth much more strongly than the upper tail. So the impact is asymmetrical, as they say. After about 3 years, we see that the effect on the 10th percentile of GDP basically ranges from around 0 to minus 3.2 percentage points, with a median around 1.6, but the distribution is clearly left skewed. So if we look at the gray area, we see that geopolitical shocks mainly increase downside risks, but rather than, let's say, upside potential, limiting upside potential. So this would be one of the first conclusions. The second is when we explore country results and we want to assess country heterogeneity, we also rely on the QVAR framework, and we look at the transmission of economic policy uncertainty shocks to individual countries in the EU. This is shown on the right-hand side chart, and we see that the responses to geopolitical shocks on the 10th percentile of GDP growth reveal sizable differences between countries. Based on the responses, we can build actually two clusters of countries depending on the relative distance to the EU weighted average response. So even though for all countries we see that EPU shocks negatively impact the GDP growth, we see that magnitude and persistence are very different, and we see that countries in the first cluster experience roughly half the shock observed as the median for the second cluster. So geopolitical shocks affect everyone, just not equally. The differences are quite sizable. And finally, another interesting thing we tested out is the risks to euro area cohesion. So geopolitical shocks also can significantly impact the degree of co-movement between financial cycles and business cycles across European countries. Events such as the Russian invasion in Ukraine may lead to either stronger alignment or growing divergence in financial and economic variables. So we wanted also to explore this, and we do so by introducing a measure of financial integration, which is measured as price dispersion of euro area financial assets, and also the extent of cross-border holdings across different asset markets. And the main idea here is that geopolitical risk and uncertainty is found to reduce euro area integration. So this indicates that increased geopolitical risk raises euro area heterogeneity, and this in turn, of course, could potentially affect macro-financial transmission and policy implementation in general. And finally, another interesting application we can do using the QVAR framework is scenario analysis. So we can simulate a scenario in which we have a spike in economic policy uncertainty, similar to that which we observed during COVID in 2020. So the results, if we simulate this, show a broad deterioration in both financial conditions and economic activity. And we see that the entire distribution of GDP shifts downward, becomes wider, and develops a longer negative tail. And this is shown on the left-hand side in the blue area. At the 10th percentile, we see that GDP growth falls to around minus 3.7 percentage points, which is a pretty severe magnitude of potential downside risk. We also test a counterfactual scenario. What would happen if financial stress is stabilized? So for example, what happens if the central bank intervenes and offers some liquidity support, or we have a higher resilience from the financial sector? So to identify this scenario, we consider that the policy of stabilizing financial stress has a direct impact on the KISS indicator for 1 quarter, and this is shown on the right-hand side with the orange area. So if we take the scenario where financial stress is temporarily stabilized, we see that distributions shift back to the right and the downside risks become smaller. And this is shown in both cases for the GDP and also for the financial cycle. We see that their distributions move towards the right. So the main idea here is that financial sector policies, of course, can play an important role in mitigating macro financial impact of geopolitical shocks. So now I give the floor back to Stephan to tell us a bit about the micro evidence we brought to the report. Thanks a lot.
You're muted.
When we complement the analysis with micro level work, we can reveal differences across financial institutions, sectors, or instruments. I will be selective here, given the range of findings in the report. But let's start with one. One analysis reveals that banks exposed to countries with higher geopolitical risk will reduce credit supply more sharply when this geopolitical risk arises. No? They did so by reducing average lending volumes, that's on the far left, so that's the intensive margin, and by having a smaller probability of establishing new lending relationships, and that's the extensive margin. So taken together, the overall kind of impact is that there is less lending to the real economy. This indicates overall a tightening of credit supply in response to a geopolitical risk shock. However, banks with larger capital headroom, and that's on the right, extended more credit to the real economy, especially to energy-intensive sectors, acting thereby as a shock absorber. This means capital headroom can make a difference for selective sectors and helps to stabilize this credit channel. So similar to the effect of geopolitical risk, banks affected by US economic policy uncertainty also tighten credit. On the left, we see the development of the economic policy uncertainty indicator over time since 2015. And when the EPU in the US increases, lending supply of euro area banks tend to decline, both in terms of total credit as well as in terms of term loans, what you see on the right. The report further documents increases in lending rates charged by banks and a reduction in loan maturity. So the loans become of shorter maturity, but at the same time of higher interest rates. This is an example of spillovers from heightened US economic policy uncertainty onto euro area lending conditions. Now, these are two examples from the banking sector. Let me move on to more to the financial sectors more generally. And for non-banks, the Russian invasion of Ukraine significantly altered euro area securities holding. Between 2021 Q4, so just before the invasion, and 2022 Q2, just after the invasion, portfolios reallocated with a home bias tendency. While domestic holdings fell by 7%, intra-euro area and holdings from the rest of the world dropped by up to 17%. That's in the red box in the middle of the two charts. Euro area financial centers saw the steepest declines. That we're talking here about Luxembourg and Ireland, reflecting the role of investment funds domiciled there. And indeed, if we look to the right, sectoral trends show that the largest reductions among investment funds, insurers, pension funds, and households. In contrast, banks at the top saw modest declines and even raised intra-euro area exposures. Again, an example of stabilizing amid war-related market uncertainty. So the financial system has been adapting to those shocks in order to kind of mitigate risks for themselves, but obviously are exposed and bring new risk through kind of more concentrated domestic holdings and hence less risk sharing overall. Now, let me come to the two concluding slides, the main takeaways. What we see is that we have a broad range of geopolitical risk indicators that point to a broad-based rise of geopolitical risk, which is unsurprising. Geopolitical risk dampens economic activity and raises risk to macro-financial variables, with especially downside risks and tighter financial conditions. Finally, financial institutions adjust to geopolitical shocks by reducing lending and developing a home bias in their overall pattern. The report, kind of overall, and linking up to what Ernest mentioned at the very beginning, provides a framework. First of all, a framework to think about geopolitical risk. Secondly, it brings together up to 40 risk indicators, uses them in a heat map, but also sets up time series and microeconometric models in order to assess and analyze the transmission of these shocks on the distribution of future GDP and financial variables, but also on individual financial institutions. So we are covering the macroeconomic effects and the financial sector reaction. Thank you very much, and back to you, Ernest.
Thank you very much, Stephan and Matei, for this excellent presentation and overview. Now let's immediately turn to Simona for your discussions. Simona, over to you.
Thank you very much. So good afternoon also from my side, and thank you very much for the invitation. It's a pleasure to discuss this, as you said, Ernest, very timely report. Let me start by saying that the report provides a very useful contribution. It develops a structured monitoring framework that links geopolitical and geoeconomic fragmentation to financial stability risks. It proposes, as we saw being presented, quite a broad range of indicators, indicator toolkit for monitoring, and they are showing the authors that these risks can be assessed using approaches such as, for example, growth at risk. In my comments, I would like to complement this perspective using our research from the Czech National Bank, and it is a joint work with Martin Hodula and Jan Janku from the same institution. The key idea I would like to sell you today in response to this report is quite simple. Monitoring geopolitical risks is important, but to understand its financial stability implications, you need to understand also the transmission mechanism, as Matei was trying to show us using different models, but also the exposure. The report which was presented emphasized that the fragmentation is multidimensional. It operates through different links, through trade, through finance links, through political, potentially, alignments, which is important. We also saw that geopolitical shocks raise downside growth, downside risk to economic growth. And we very much agree with this perspective. Our work adds to this, I would say, 3 additional layers or 3 additional messages, which I would like to try go in a bit more detail in my slides. But first of all, what are these messages, these layers? GPR shocks are episodic. The second one is that the financial channel acts as an amplifier, and we saw some analysis on that also from Matei. And the third one is that the proximity to the shock, to the geopolitical event matters for capital reallocation. Okay, back to the first message. Geopolitical shocks are typically sharp and episodic. They are triggered by very concrete events, as we are seeing for the last few years, such as wars, sanctions, but also in general some geopolitical tensions. When such an event occurs, uncertainty rises among several domains, not just one. However, while these shocks are usually temporary, their transmission is not. The transmission could last up to several months or even longer. It could be persistent. This leads, I would say, to important policy implications. Monitoring should not focus only on the level of the geopolitical risks, but it should focus on how these shocks propagate through the financial markets and real economy. This is quite simple and intuitive. The next slide tries to place these geopolitical risks using the very well-known Kaldaya-Quio GPR index among a broader set of uncertainty measures, which we are using in our monitoring toolkit in our papers. It shows that GPR does not only evolve in isolation, but it tends to move together with other uncertainty indicators. And from the heat map here, you can see that it usually moves together with trade and migration type of uncertainty. This suggests that geopolitical risk should be interpreted as triggers of these stress events, stress episodes, within a wider set of uncertainty environment. And again, we saw it from the indicators from the report. And it shouldn't be treated only as continuously active state-dependent variable, I would say. The second message, and again, it relates to the paper or to the report by Matei and Stephan, is that the financial channel plays a crucial role in this transmission. In our framework, we also distinguish, not surprisingly, between financial channel, which is a fast-moving channel, and between real economic channel, which is slower and more persistent. The financial channel works through the usual suspects. When the geopolitical risk rises, investors generally reassess their risk, portfolio reallocates, and asset prices adjust. Also, and we will see later on, the exchange rates, foreign exchange markets can act quite quickly, quite fast to these shocks. Equity markets respond, and also the debt markets funding condition changes. The second, the slow-moving one, the real economy one, over time, we can see the geopolitical tensions act through trade, supply chains, also inflation dynamics, corporate profitability, and these back feeds to the credit risk and to the banking sector. For monitoring purposes, what does it mean is that a financial channel is particularly important because financial markets often react quicker, faster than real economy ones, and this can provide early signals of stress. But the third message, and I think this is potentially the most important among these three, is that is the concept of the exposure. And what does it mean? Monitoring framework needs this exposure layer according to our analysis. We need to ask which economies are more sensitive. We saw that there is a heterogeneous response among euro area countries, and we are trying to answer potentially what's the reason why different economies react differently to these geopolitical shocks. In our recent work, we start with a simple intuitive metric, and this is the geographic proximity to the conflict epicenter. This proximity is not the transmission channel itself, it's rather a way how to structure the exposure. It tries to capture expected spillovers, it tries to capture perceived tail risks and potential investors' beliefs about which economies are more affected. Okay, when we combine this GPR event, this narrative identification on different GPR shocks and stress events with cross-border capital flow data, we identified quite clear pattern. At the beginning, at the onset of some geopolitical event or shock, capital reallocates systematically across countries according to these exposures. Countries that are closer to these events, geographically closer, tend to experience capital retrenchment, while the more distant ones, they often receive these offsetting inflows. If we look closely at the sequence of these market reactions, we again find some interesting ordering across different markets. Equity flows usually respond quite quickly. Investors rebalance their portfolios away from these exposed markets, again towards more distant ones, safer ones. Debt flows, they also adjust, but the reaction may take up to several months in our data set, which likely reflects some rollover frictions or potentially some slower repricing in these markets. But even more interestingly, exchange rates tend to react even faster. So FX markets, they quickly price the GPR stress, geopolitical tensions, or wars, conflicts, usually with currencies of more exposed, more proximate economies depreciating relative to those that are perceived safer, are more distant. This sequencing, again, has, I would say, practical implications for monitoring, because foreign exchange markets and the reaction there may provide the earliest signal of the geopolitical stress and its materialization. Then equity markets flows, they reveal the potential portfolio reallocations, and with some lag, also debt markets can adjust, and their reaction is more relevant for medium-term funding conditions and financing risks. If we put all these three messages together, we can propose a monitoring framework that combines three layers. The first one is the trigger, the possibility to identify geopolitical stress event, the shock. The second layer is the exposure mapping, which means to identify the countries that are more vulnerable based on either the geography, but also potentially trade linkages, financial linkages, or maybe some political ties or alignments. And the third layer is the sequencing of financial signals, from foreign exchange markets, the immediate repricing, to equity, to debt markets. In this sense, the geopolitical fragmentation does not only increase systemic risk through uncertainty, it also reshapes the geography of global capital flows and the financial conditions. And I also prepared, as my last slide, potential three discussion points for authors. This is my concluding slide, and it follows the perspective of the report, but also the perspective of our research. The first one is when the geography, trade linkages, financial linkages, and potentially political alignment disagree in terms of the exposure ranking to the conflict or to the GPR stress. How should we prioritize them in the monitoring? The second question is, do these different types of geopolitical events, wars, sanctions, political tensions, do they have a distinct market signature across different markets, equity, debt, foreign exchange ones? And the last one about the fragmentation, what makes this reallocation persist? And I have a few examples here, and if there's some intent to follow up on that, I'll be very happy. So that's all from my side, and I'm looking forward to the other two discussions.
Thank you, Simona, for these extremely thoughtful comments and also for the very concrete questions. We'll come back to them in the next round then. Let me now turn to Falko. Falko, over to you.
Thanks very much for having me discuss this interesting report. And I think what I'd like to do is focus a little bit, as Stephan was already anticipating, on section 6, or the last part of the presentation that the two gave today, and the micro evidence of how geopolitical risks affect the risk-bearing capacities of banks and how that spills over to their lending behavior. I'd like to add here a slightly different perspective, linking also the financial stability implications of geopolitical risks towards the implications that this has for monetary policy, and in particular monetary policy transmissions. My comments will be largely based on a joint paper with Stefan Gebmeier and Björn Beovic. The paper is called A Geopolitical Shock to Bank Assets and Monetary Policy Transmission. Just to quickly recap, in my view, the main takeaways of this section 6, or the last part of Stefan's presentation, where they basically use low-level data, so micro data, to specifically identify channels of contagion between geopolitical risks on banks' risk tolerance or risk-bearing capacity, and how that affects their lending activities. So I think the main takeaways that he already nicely presented is that this micro evidence shows that energy-intensive firms experienced tighter credit conditions after the Russian invasion. Secondly, he also showed that banks with larger geopolitical risk exposure in their credit portfolio reduced their risk tolerance in their lending conditions after the invasions, reduced their credit supply, basically. And a similar effect they document also for banks that are more exposed to the US on their asset side, Euro area banks that are more exposed to the US on their asset side, that they also reduce their credit supply in periods when the US economic policy uncertainty index is particularly elevated. So overall, I think what these results nicely show is that geopolitical risks have financial stability implications for banks, spill over to banks, and thereby also reduce credit supply, and therefore impair also the availability of credit to the non-financial sector. Now, what we try to do in our paper is basically to take a slightly different perspective and extend somehow the view and see to what extent these financial stability implications of elevated geopolitical risks, right, also impairs monetary policy or affects the monetary policy transmission. And what we are doing, therefore, is we are zooming a little bit further into the transmission channel, and we show actually that the geopolitical shocks work actually through the bank lending channel, not through the bank balance sheet channel. And that means that basically the realization or materialization of a geopolitical shock leads to higher refinancing costs of those banks that are more exposed to a shock. And we are here exactly looking into the banks that are more exposed to Russian borrowers and Belarusian borrowers. They, after the invasion, had faced elevated refinancing costs in the wholesale deposit markets, as we show. And actually, therefore, because they faced these higher elevated refinancing costs, they also cut back the lending to the domestic non-financial firms. And this basically shows that this geopolitical shock actually caused a silent monetary policy tightening through the bank lending channel. Right? So it reduced basically credit availability and real economic activity. What we're also able to show with our analysis, with our microdata that we have available, is that more exposed banks not only tightened their lending conditions, but also responded more sensitive to the subsequent monetary policy tightening, making the monetary transmission mechanism more intense than non-exposed banks. So both effects, I think, are very important to bear in mind for monetary policy, and suggest that geopolitical risks are therefore also essential to understand for monetary policy makers. Now, what is the data that we are basically using? Very similar to the analysis that Stephan was presenting. We're using unaccredited data, so loan by loan statistics from the Euro system. But we complement that with the MMSR data, which basically gives us the wholesale deposit markets, transaction level data on wholesale deposits from non-financial corporations. Here that restricts a little bit our sample, because for that data is only there we only see transactions for basically the 28 banks. But for those 28 banks, these wholesale deposits basically account for roughly 10% of those banks' total assets. Now, how do we measure the geopolitical exposure? Here we are not really looking into a geopolitical risk indicator. We are looking here into actual exposures. So we are basically taking Euro area banks' loans and bonds issued by Russian and Belarusian borrowers relative to bank equity, to each bank's equity in 2021. All right? And we basically label banks that are to be highly exposed if they have an exposure that accounts for more than 2% of their total equity. Now, what do we see when we use this such defined exposure? We find when we look at the deposit rates, our hypothesis, that's relatively straightforward, that banks that are more exposed have also a higher probability of needing to write off those exposures, have therefore a lower risk-bearing capacity, higher failure risk. And that means that uninsured depositors, right, might require a higher risk premium, or if they're not being paid this higher risk premium, they might tend to withdraw. And that is exactly what we see when we when we run some local projections, as we see on the right-hand side, right? More exposed banks or highly exposed banks have indeed a significantly elevated deposit rate to pay in the wholesale deposit markets after the Russian invasion as compared to non-exposed banks. And at the same time, those banks also have lower access to wholesale deposits. The wholesale deposit volume significantly drops in the months after the Russian invasion. So if we do then a fully saturated diff approach with depositor time fixed effects, we still can identify exactly this effect, and we estimate that an exposed bank pays basically to the same wholesale depositor on the very same day, on average 5 basis points more than a non-exposed bank. And that was at a time, to remind you, when the interest rate was basically what the wholesale deposit rate was an average at minus 57 basis points. Now we tried to back out through an approach suggested by Schudorov-Reich and Federico, how much of a policy rate increase would be required to basically generate the same refinancing cost increase to the exposed banks. We basically come up with an estimate, a calculation that an equivalent policy rate increase for the exposed banks would amount to 57 basis points. So quite a sizable increase in the monetary policy rate for those exposed banks. Finally, for that also, so to put things together, what that means is that the geopolitical risk here really leads to a silent tightening tighter refinancing costs for the exposed banks through the bank balance sheet channel. And these results are basically also confirmed if we look at more aggregate data through the EMIR statistics. Now, on the asset side, and that basically replicates some of the results or confirms some of the results that Stephan was already presenting. When we look at the loan side, well, the hypothesis here could be that more exposed banks that have to write off larger parts of their loan portfolio or expect to write off larger parts of their loan portfolio have a lower risk-bearing capacity, but also potentially higher refinancing costs, and therefore also need to tighten their lending standards and will provide more expensive or less loans to non-financial firms. And the results that we see on the right-hand side with, again, some local projections is basically that to the largest extent we see a volume effect, that the lending to non-financial corporations is significantly going down for exposed banks as compared to non-exposed banks. However, the loan rates are not so significantly higher for that exposed banks charge as compared to non-exposed banks. Again, if we run a fully saturated diff-in-diff approach, we estimate that exposed banks grant a 3% smaller loan to the same firm on the same day to a given non-financial corporation as compared to a non-exposed bank. So again, a relatively sizable amount. However, the question that we are actually after is to what extent is this credit supply effect actually driven by tighter refinancing costs of the banking sector? So what we are trying to figure out is, do banks reduce their lending because of their tighter refinancing conditions in the wholesale market? And the approach that we're taking here is to simply regress the loan supply of a specific bank on the bank's increase in the wholesale deposit rate right after the invasion of Russia in the Ukraine. All right? Therefore, that allows us basically to relate the reduction in loan supply to the bank's specific increase in refinancing conditions. And what we do find, and that's the result in the first column of this table here, is that there's a significant effect, a significant and relatively strong effect of the increase in the wholesale refinancing costs of a bank to, right after the invasion, to its credit supply shortly after the invasion. Right? This is also true if we try to estimate basically the effect on a bank's increase in the wholesale deposit market and relate that to the bank's characteristics and the invasion. So the explained part of the increase in the wholesale deposit rates for a specific bank are really the one that is the one that is driving basically the increase, the reduction in the credit supply of a particular bank. So the results suggest that a strong geopolitical shock induced deposit rate is actually the one that increases, that leads to the tighter credit conditions in the post-invasion period. But what we then also are able to show basically is that these also has indeed real effects. This cutback in credit supply, we see that firms that are more reliant on exposed banks' credit provision will have also an aggregate drop in their overall credit available after the invasion. And we also see that firms that are more dependent on credit provision by more exposed banks will also have a decline in their aggregate investments after the invasion. So this suggests that indeed this geopolitical shock through the bank lending channel also leads to a diminished aggregate demand subsequently, and therefore mutes somewhat aggregate economic activity. Finally, quickly, also to the effect on monetary policy transmission. So the question that we are also trying to ask is that does the geopolitical shock also affect the transmission of monetary policy through banks funding and banks lending. So does the geopolitical shock tighten basically the bank lending channel and make lending more sensitive to monetary policy shocks? Here, I think that the mechanism is relatively straightforward. A higher exposure should lower the net asset value of a bank, and that makes it more sensitive to monetary policy changes because the external financing premium becomes more sensitive to the monetary policy rate. What we do is we use a sample period from shortly before the invasion to February 2023, which encompasses basically 5 policy rate increases of the ECB. And again, we're looking into MMSR and anacredit data to look into the aggregate effects. Now, what we do is we look into different types of, we measure monetary policy shocks in 2 different ways. On the one hand, by a change in the deposit facility rate, and on the right-hand side through properly identified monetary policy surprises following the approach by Jaroczynski and Karaadi. But here for the deposit rates, what we are finding is that irrespective of the monetary policy shocks, of how we measure monetary policy shocks, we find that more exposed banks' deposit rates are much more sensitive to monetary policy shocks as compared to non-exposed banks. So for instance, we see that an increase in the deposit facility rate by the ECB of 100 basis points translates into a 30 basis points higher deposit rate increase for the exposed banks as compared for the non-exposed banks. That also is basically reflected on the asset side. Also here we see very similar results if we look into the impact of monetary policy shocks on the loan rates that banks charge. Quantitatively, the effect is almost identical. Again, we see here that a 100 basis points monetary policy increase translates into a 30 basis points larger loan rate increase at exposed banks compared to non-exposed banks. So to basically wrap those findings up, what we find is that geopolitical shocks operate actually through a bank lending channel, generating also a demand contraction, along, of course, also the supply side pressures that are typical. Furthermore, we also find that geopolitical shocks affect the stance of monetary policy through the silent tightening. But at the same time, we also see that the transmission of monetary policy is also affected by the geopolitical shock, that lending becomes much more sensitive to monetary policy rate changes. So what that suggests is that policymakers need to account for these effects to avoid an over-tightening when recalibrating policy in response to a geopolitical shock. And geopolitics need to be an essential part for calibrating monetary policy in general, right? So geopolitical risks affect not only financial stability, but also through financial stability concerns, they interact with monetary policy. And I think that's the main takeaway of our analysis. And thanks very much.
Thank you very much, Falko. Now let's turn directly to Álvaro.
First, thanks for the invitation to SUERF again. Has been a pleasure to read the report, and I highly recommend the lecture because it's very complete, very hard. The comments that I'm going to do today are the fruit of our work with my colleagues, Tomasa Rodrigo and Pablo Saborido. What we are going to try to elaborate today is that how different shocks, geopolitics and geoeconomic, use different channels and what are the consequences. Okay, first, something to remind why this event it is very, very timely and very relevant. the US-Israel-Iran conflict. You can see there our real-time indicators in the web page. But what we observe is that the geopolitical risk sentiment has increased to extreme levels in the Middle East, in the Gulf countries, but it has been contaminated, for example, to the European countries. On the right, what you see is our scorecard. We have plenty of indicators of geopolitical risk, economic policy uncertainty in foreign and local languages, political tensions, trade uncertainty, and what you see is that we are mostly in red again, when in December, for example, most of the scorecard in yellow, which is the new. Okay. Also, from our webpage, what you can observe it is that economic come to the fore in a broad basis. At the beginning of this year, present at the end of December, but in some of the countries, like you see, for example, in Middle East and North Africa, it is especially intense. However, activity holds in the light colors. This is our brand new economic sentiment indices by countries. What you see it is that uncertainty has been transmitted to economic sentiment only in some of the countries, Iran, Yemen, Bahrain, and so on, but it remains at still safe levels so far. Okay. So with all of these indicators, what we were interested in is to build up a system, diagnostic tool, to understand the difference of the different channels of geopolitics and geoeconomics hitting sovereign risk. In our case, our dependent variable is the credit default swap of the countries. For that, we have a three-layer system. In the first phase, what we rely it is in machine learning models. I will explain now later why. For those who are familiar with this model, you will need the supply tailored decomposition tools to disentangle what is in the black box machine learning models. And finally, we're not going to talk today, a causal validation with local projections to confirm that our results are robust to the traditional models. The first important thing is why non-linear or non-linear adapted model. And what you see, geopolitical risk index and trade policy uncertainty with geoeconomics. For those who are working with econometric models, the first thing to your mind is, and in fact, normally geoeconomic events are non-linear, okay? And this has some problems with spikes, regime breaks, time variant volatility, asymmetric tails, and so on. And this, if you introduce this time series in the models, you can do it, for example, to monitor the situation very well. But if you decide to introduce this series in time in models, you can see that your estimates could be affected, your interactions not visible, and country heterogeneity could be missed. So you have some solutions. Fortunately for that, it is that you can adapt your non-linear models to linear ones, and that's some people by regression, or you can use directly non-linear model, which is our strategy. So we use these non-linear machine models. We're competition. The idea it is to try to understand sovereign risk, credit default swaps, as a function of geopolitical variables, which is coming from our indexes, geoeconomic uncertainty variables in yellow, which are also coming from our indices, local sentiment variables, interest rate, economic sentiment, and political rate, but also combined with global financial variables that we take from market, which is the Federal Reserve expectation as a global as a proxy of global monetary policy rate, the 2-year bonds, and global volatility, which is the the VIX index. Again, if you use this nonlinear model, you will need the supply decomposition, and thanks to the supply decomposition, what you will see it is that the black line it is your credit default swaps. In this case, for Israel, this is what happened after the shock, and here you see the decomposition on why this spread has become so elevated. There are most of the variables were contaminated. The purple is the geopolitical risk, but immediately in these countries, all of this is deteriorating very fast. The macro macro and this uncertainty steps the global financial variables, which are exogenous, which are in the blue. We wanted to give another question. It is what happened inside the purple, inside the, for example, the geopolitics, and we also explore in the paper which are the direct and indirect effects of, in this case, of geopolitics, but for geoeconomics are for the other shocks. So this is the full decomposition. Let's go to the results. I think it is the table of the machine learning race. It shows three interesting things. The first, it is that nonlinear models, which are at the bottom of the table, perform, dominate our sample forecast. The second, it is that relative to the benchmark, which only include news variables, the Federal Reserve and the VIX, that news can add up to 20% in value to your models. And the third and important one, it is that to capture the nonlinearity of your news, it will be easier with the random forest with the nonlinear model. So it is just to remind what are the potential effects of the nonlinearity. Thanks to the subpolymerics, we can also account for what's the relevant, which are the main drivers of this sovereign risk. Okay. And there are no news here. The main important by region and by asset class variables are global monetary policy and global financial volatility. And this is reminiscence of the Calvo models, Helen Ray dilemma, not trilemma. This is something which is not new. The second one, it is the local interest rate and local economic sentiment, so the macro. And third, which are also relevant, it is the geopolitical and the economic policy uncertainty and trade policy uncertainty that we associate with geoeconomic uncertainty. So the result, it is that these variables are not relevant. That means that you have to forget about this, that this is nothing happened? Not at all. Why? Because the geopolitics, for example, is highly state dependent. So the shocks are small in isolation, but can be very powerful in interaction with global financial markets. Let's see how it operates. Imagine that you have a combination in isolation with policy uncertainty and geopolitical risk. What will be the effect instead of the risk? Almost nil. So in isolation, they don't have much effect, this one, okay? What happens if you go then in a situation that this economic policy uncertainty start to affect to global financial volatility, maybe because the people start to price a higher interest rate, then the surface of risk start to increase. What happened finally in the combination that already with the global financial volatility, the central decide to react, maybe because they believe that this financial volatility will and inflation will deteriorate too much, and they implement an aggressive tightening. This is what happened. This is a story of how, from a geopolitical shock, you can end up with a more problematic situation. The second, it is about how the geopolitics and geoeconomics operate through direct effects or through indirect effects. Here, what we find is what we call the scissor effect in the geopolitical shock, which is important in this shock. It is the direct effect, but sometimes it is compensated, for example, with a parallel movement easing the situation in the blue line, which is the global. Okay. The transmission of the geoeconomic shock, it is different. It is not as much with the direct effect, but also it is operating mainly from the global financial channel and the local. So how the shocks transmit are quite significantly different. What is happening with when you disentangle the direct and the indirect effect? Then the results are becoming very apparent. This is the direct geopolitical shock. The measure the distance to the conflict. So what happened and what we see, it is the Russia and Ukraine invasion and Israel Hamas. So gravity, it affects sovereign risk, and the direct effects decay with distance from conflict. This is important for us because we are very close to, for example, to what is happening now if in the world. So European countries are closer to this conflict zone and will be more affected than, for example, Latin America, which is in green and are from here. Okay. Let me explain some analysis what is happening today, what happened in Russia and Ukraine. So I will tell you the narrative that the Taylor interactions give us. It is a story of a geopolitical shock morphing in a systemic financial crisis. And here is very important, the sequencing of the shock. So the first, it is that you see Russia and Ukraine, and we have a geopolitical shock in purple, okay, but it is very evident. In this country, it is not only the geopolitical shock, but everything deteriorates in the country, in the affected countries, deteriorates at the same time. The macro, the expectations, so the only exogenous as the variables. What happened to the neighbors? Germany, Poland, Finland, Austria, Czech Republic, and Sweden. That the mechanisms start to operate. So the second important thing is that the uncertainty shock start to play, which is the yellow one, start to go on the upper side. The upper side is the deterioration of risk, and at the same time, the local macro start to contaminate, which is the gray. Some moment of time, the global financial market start to react because the big central banks, including the Federal Reserve, but in this case the European Central Bank, started to signal and also to materialize de facto interest rate increases. This effect also reinforced the movement in the VIX, and this is what happened. You see that at the end there is a total significant risk increase, as we saw in the 3D graphs. What is the situation now? Where are we now? It is still early to say. United States and Israel, we don't have for Iran because they don't have a credit default swap in movement. But what you see is that they have started to be affected. These are average of 28 days, but uncertainty and geopolitics have started to price in. Okay. In the case of the Germany, Austria, Czech Republic, and my country, what we see is that in Germany, was in a very good situation before the crisis, so that means credit default swaps before the long-term average have started to reverse the part of the geopolitics, but this maintains more or less stable. This is the same of Czech Republic. Austria have started remaining the same, and in my country, just because we are far from the conflict zone, the continue to risk. So let me summarize and raise some policy implications. The first is that geopolitical shocks reprice sovereign risk directly, okay? But geoeconomic shocks are different. They transmit through financial conditions, uncertainty, and local macro. There is a scissor effect. It is that the same spread widening because of geopolitics can generate opposite channels working in the opposite direction. Like, for example, global financial condition just muting the original effect. The second is the geography. Direct geopolitical effects decay with distance. This is very obvious from Russia, Ukraine, but also from the Hamas-Israeli. Conflict proximity. The exposure, the gravity pattern hold across all of 4 geopolitical episodes included in the paper. The diagnostic, we stress that identifying which channels are active in real time tells policymakers whether they can stabilize the shock or whether it must be resolved after. What could be, for example, different policy reactions? If global financial condition channel dominates, there are room for stabilizing via liquidity provision or swap lines in the markets. But if direct channels is dominating, especially in the geopolitics role, financial tools could be insufficient, and we will require another structural reform and diplomatic de-escalation. So thank you very much.
Thank you very much, Álvaro. Now, what I want to do with the remaining 15 minutes or so, first of all, give Stephan and Matei the opportunity to reply to the various comments, including the concrete questions by Simona. And second, I want to throw in a couple of questions which I've received meanwhile from the chat. A question from the chat is technical. In regards to the indicators by category, are the data sources publicly available? Were the weightings of these indicators done using static or dynamic techniques? And then some more policy-oriented questions. Now, building on what Álvaro just showed us, how would you apply your findings in the ECB report to the current Iran shock? So what shocks are at play? How does the current development mirror the Ukraine war? To what extent is it different? Is it just an energy shock, or to what extent does it differ? And how does the transmission of the shocks this time work, depending on how long this episode will last? Then another question, coming back to Falko's concept of silent monetary policy tightening. To what extent are we seeing this at the current juncture? And what are the implications for the further course of monetary policy? Falko, you gave some indications of what you think monetary policy makers should think. So maybe we could become a little more concrete in that respect. And then another question that I would be interested in is modern warfare, as we are seeing, both in the Ukraine war and now also in the Iran war. Modern warfare increasingly focuses on the disruption of various types of infrastructure. This way, physical damage combines with the disruption or even destruction of IT and AI infrastructure, as well as financial infrastructure. How to gauge such combined shocks? The impact of such combined shocks may be bigger than their sum. Might be at play some kind of multiplicative uncertainty or that kind of thing. Stephan and Matei, do you want to start?
I'll give it a start, and I would like to say thank Simona, Falko, and Álvaro for also exposing their work. I think putting it together, I mean, it gives a picture where we need a lot of data on the one hand, and we need kind of nonlinear models that kind of treat this. Plus, and this is something potentially new, both Simona and Álvaro pointed to that kind of local information that kind of in the bilateral kind of, this is captured either by distance or by any kind of relationship that may be to the source, so to say, of the geopolitical distress. So I found this highly interesting, and this shows that there is a research agenda that to continue, which is very, very interesting. On certain aspects, and I will not take them all in the same order. Just to be clear, there have been, so the indicators that we used are publicly, most of them are publicly available, and we in the report there are also the references where to find them, so you may check it from there. We did not. There has been a choice in the work streams that we did not aggregate those. So we gave categories to the individual indicators, but we decided not to aggregate them by factors or however, in order to really see them together and take out their information. We thought that there might be too much of too lengthy discussion about which methodologies exactly used, and I see Álvaro takes the kind of the view of he just computes them all, and by doing so provides additional information, which is great. There is one question that was on KISS and the geopolitical part. So just to be clear, what we have analyzed, obviously, the interrelation between the composite indicator of systemic stress that the ECB has and the geopolitical indicators. And what we found is that for many of them, the correlation is very low. How we interpreted this is that kind of up until now, these geopolitical events are, so to say, exogenous to what happens within the euro area. And we can therefore take those effects also in our regressions as two explanatory variables, and this was an important step. Perhaps to now picking up one of your Ernest, of your questions. how is the current crisis with Iran similar or different? Well, it is. So the similarities, there's a war, no, and there are two aspects that are similar and different at the same time. One is the energy is it's affecting the energy sector, and the similarity, that's the similarity. But in the difference within there is that the focus during the Ukraine in the beginning of the Ukraine invasion and the inflationary spike that we have seen there, it was very much gas driven. Whereas now the focus is still predominantly on the oil, but I don't want to exclude that there will be also a shift that takes place because both Asian countries and European countries are looking at having demand for gas. So currently the focus was more on the oil and seeing all those oil tankers kind of stranded, so to say, this is a difference. The second part is a difference about or relation different is about the role of uncertainty. While the Russian invasion of Ukraine kind of got a fundamental uncertainty about the political order in which we are, how will that continue? Now the uncertainty is rather how long will this crisis perdure? Is it a short-term crisis or is it a long-term crisis? It's a different uncertainty type. Now, I cannot tell you what the different implications of that are, but I just would like to point that out. With that, I'm happy to pass on to Matei.
Thank you. Matei, what's your take?
Thanks a lot for the interesting comments and the presentations. Now, I realize after 1 year of working on this group that and hearing the presentation that I think we're kind of scratching the surface still of geopolitical risk transmission. So it's very, very glad to see all of these new directions. Just to, if I may, to link a bit and complement with some other information from the report. So related to Simona's take on exposures, that was really interesting. And I want to let you know that we kind of tested this when we did the country heterogeneity experiments. In the interest of time, of course, we didn't explain all of this, but we have in the report, we tried some geographical distances. It didn't turn out quite as we wanted it, but we found that fiscal balances and banking sector resilience were indicators which were good explainers of this heterogeneity. So we saw that countries with better fiscal position, better banking sector resilience were having lower impacts when we were looking country by country. So this is thanks for reminding us of this, and maybe it's interesting to complement on Álvaro's very interesting work on all the machine learning techniques. We also have a small exercise in the annex where we selected some indicators when we were testing out the growth at risk framework. We also added all our database in a machine learning exercise, and we took out the most relevant, and it kind of overlapped with our intuition and with what we selected. So that was I guess good on our part, on the intuition part. And on the questions, yeah, I think on the war issue, a lot of modeling choices and difficulty stems also from the way the indicators are built. So if we look, and this was an important point in the project as well, because when we were looking at the GPR, for example, which is one of the best proxies, let's say, for the war part, military, and so on, we saw that it also depends a lot on where the GPR information is coming from. So you will see that the general GPR one is more US centric, and so it puts a lot of weight on US based information, whereas in Europe, if you would build something similar from European newspapers and data, you would get much larger spikes, for example, for the Russian invasion in Ukraine than for 9/11, for example. So this is something which really, because this basically impacts a lot the transmission mechanism and the results when you look at our models. If you don't have this, so one part comes from this, and I think this would be also applicable to the Iranward transmission mechanism. Of course, here we have a much, let's say, much more direct idea with the oil price, which of course can be modeled through our usual monetary policy tools and macroeconomic modeling. So I guess here the impact maybe is more concrete, but of course, as Stephan said, there is still a lot of uncertainty and a lot of unknowns. So I think we're better off maybe with some scenario analysis now rather than direct modeling, because we really are in a very volatile period. On the KISS, exactly as Stephan said, we see, I think we see two major roles and two major conclusions coming from this. One is related to the volatility paradox. So the lack of transmission between spikes in geopolitics and transmission in the financial sector. This has been a question we've had in many committees where we presented the report, and I think it's still an open topic if markets are getting used to it or there is something else at play. And the fact that the KISS is representing this amplifying channel as we've seen in the presentation. So when we shut it off, definitely the geopolitical risk transmission dampens towards the economy. So it really plays a role. So I think it's very important to have it there in the models. On the disruption, it's a very interesting subject. We didn't approach it in the report. So, but I think foresight and preparedness are, very interesting channels, and they're being explored at European level. But I think they were a bit beyond what we were doing here. But happy to hear any other thoughts. Thanks.
Thank you, Matei. Simona.
I just briefly agree actually what Stephan and Matei said. I really like the idea about the different sources of uncertainty, or different types of uncertainty for the Ukraine and for the Iran situation. Not about for the Ukraine, it was about the world order. For Iran now, it's about how long it will last. One thing that came to my mind is that maybe there is even another source of uncertainty now is what will be next. If this will end, what will be next? So because we know that something will happen, so now we are living in an environment of continuously heightened uncertainty and different types of spike, and the only certainty now is that we know that something else will come once this is over.
We're uncertain about the level of uncertainty now.
Yeah.
Thank you. Meanwhile, we also received another question on the impact on emerging economies versus advanced economies. And I find this quite interesting because several of you emphasized the importance of geography. And it seems to me that there is an important distinction between Ukraine and Iran. With the Ukraine war, Europe was mostly affected, whereas now, in the current situation, oil supply for Asia is at risk. Falko, what would you comment?
Yeah, I mean, thanks for the question on the current relevance of the silent tightening. I think my answer strongly relates to what you just said. I think, I mean, the exposure, at least, of the European banking industry towards Iran, I think, fairly limited and non-comparable to the exposure that European banks had towards Russia and Belarus. So I think because of basically the financial sanctions that were imposed for a long time on Iran, there was basically very little, if any, connection there. But at the same time, of course, I mean, it depends very much on how energy shocks will persist or not, whether oil prices will remain extremely elevated. I mean, this might also mean that energy-intense sectors might turn out to be a credit risk on the books of the banking sector. And then if we have really a persistent elevated energy prices, then eventually we might have a similar effect, right? That banks have to write off potentially parts of their credit exposure towards energy-intense sectors, which can again lead to something related to this silent tightening. But of course, at the same time, we have also a very strong supply side effect. So, and which one of the two is more intense, then very much depends on the persistency and also the exposures. Furthermore, what I also like to stress is that currently we have also a countervailing effect on the demand side, which are the defense spendings. Right, that I think increases quite substantially aggregate demand, in particular in Germany right now, right, and stabilizes therefore even a potential decline in demand due to a silent tightening. So therefore, I think unfortunately for our paper, the silent tightening currently is probably not as relevant at the moment, at least, as it was during the Ukrainian invasion by Russia.
Thank you, Falko. Álvaro, you already gave quite a few figures and analysis on the current crisis. You were also for 6 years in Turkey, and BBVA is also engaged in Turkey. So if we take the finding that proximity matters, what's your reaction to that?
An easy answer to one of the questions. Yes, we have updated in our webpage the daily indicators for this. They are available. On the Turkey, on a general question, I think that part of the lessons of the paper is that a lot of things are happening at the same time. So it is important that you disentangle or differentiate which channels play. It is obvious that relative to in the actual situation, the direct effect it is operating. Turkey is a neighbor, but we are in Europe a neighbor, and the Gulf. It is already present in our indicators, in our heat maps, that some of them sentiment indices are suffering, but it is also much more important channels, and then on the policy reaction, that a lot of things are part of the war. This is the reaction of the energy prices that it is not in our model, but also the reaction of the global financial markets. Okay, and this is very important, in my opinion, that this channel remains inactive or even is in the situation. Because this is the key important ones. If global volatility and interest rate expectations start to tighten, this is going to be a different scenario, even with the high prices. If markets have said that energy prices are going to be up for a while, they remain calm in terms of volatility, and this happened in some of the weeks in the first week after the war, it is going to be a much more different outcome. So the lessons from the Ukraine on this, it is that it was a sequence from geopolitics, uncertainty, economics, and reactions on policy. The shock, it is a supply shock, and I think that, in my opinion, monetary policy authorities should wait and see what happens and not to react immediately, because this can complicate the thing. So there is nothing to do with the direct geopolitical effect. This is not a demand shock, so I will wait until the end. And it looks like in this situation, maybe we learn something from the response to the Ukraine. And finally, there are things that could be done in order to move the response of the markets. It can deteriorate. We have the swap lines and whatever, and also tools that could be effective. For the rest, I remain with the rest. This is the no unknowns. We know that we don't know that how long it is going to last. So it is important to have the necessary tools to monitor this in real time for the policymakers to react timely of what is happening. But again, a lot of uncertainty. It is not only about targets about Europe and especially the Gulf countries that fortunately they have enough wealth to cope with this situation for a while. But let's see what happens. And with one eye, you can see the missiles and the ballistic and whatever, but with the other eye, you have to be very careful of what is happening in the markets, and not only in the energy markets, in the global financial markets.
Thank you very much. Now, this concludes today's e-lecture on the ECB-ESRB report on the theme of financial stability risk from geoeconomic fragmentation. I think it has become obvious that this report, as well as the papers and the data sets presented by our discussants, are absolutely worth reading and having a close look. It has also become clear that this is work in progress and that we are learning by doing and learning by observing, and that there is really fast progress on the methods and the indicators that are used. And once again, congratulations for the work that all of you have done. This is really cutting edge work and very important work. Let me extend a warm thank you to our presenters and discussants, Stephan, Matei, Simona, Falko, and Álvaro, for your rich presentations and for the open discussion, and to all of you for your interest and your questions and comments. Bye-bye and take care.
Bye.
Thank you. Bye.
Bye.
Bye-bye.
Bye.
Thanks.